Welcome back to Softgate Capital Research, where we dive into fresh equity research from around the world. I'm Emily, and I've got my co-host David here with me today. David, you ready for this?
Absolutely, Emily. Today we're shifting gears, no pun intended, taking a deep look at Aston Martin's 2025 outlook. For our new listeners, Softgate Capital Research is the independent research arm of Softgate Capital, the asset manager. Our goal? To help investors break down the most interesting companies with a focus on the fundamentals and the bigger picture risks and rewards. So, let's get to it.
Aston Martin is in some pretty exclusive company. Think about Ferrari, Lamborghini, Bentley, and Rolls-Royce. They really emphasize scarcity and exclusivity, keeping annual production at just around 6,000 vehicles. That's nothing compared to mass automakers. The big change recently was the DBX SUV, first launched in 2020. I actually went to that media event. It was wild. Everyone knew that moving from those beautiful but, let's face it, pretty niche sports cars to an SUV was a bet on a broader luxury market. Now you've got upcoming models like the Valhalla hypercar and a new Vantage on deck, plus expansion plans in China and the US, which is a big deal.
That's right, Emily. The DBX now accounts for about half of Aston's volumes. It's targeting the same luxury SUV market carved out by Bentley's Bentayga and Lamborghini's Urus. And with strong sales momentum in China and US, they're trying to shed that collector-only image, aiming for a swath of well-heeled buyers who want something a bit different from the mainstream German or Italian badge. Let's talk performance. Aston's recent 5-year stretch was bumpy. Pandemic hits, restructuring, and a 2-year dip right after IPO. Their volumes dropped, and free cash flow is, well, you're not really seeing much until at least the second half of 2025, according to management. Revenues recovered in 2023, but margins are still much weaker compared to Ferrari. If you look at the core financials, EBITDA margins for Aston are around 9%, while Ferrari is operating closer to 35%. That's a massive gap. EBITDA multiples? Ferrari's trading at 18 to 20x. Aston's below 5x, but for good reason. There are execution risks here. Product delays like with the Valhalla, supply chain snags, and weak cash flow.
Yeah, and that's why our equity rating here is neutral. There's upside if execution improves, no doubt, but management's got to prove it with upcoming model launches and margin expansion. Until those positive free cash flows show up, a lot of investors are keeping Aston at arm's length. Let's shift over to electrification. Aston Martin's been a bit behind here. They're only pushing out their first battery EV after 2025, even though the V8 Vantage and Valhalla have some hybrid elements. Now they've got this partnership with Mercedes-Benz, tapping into Mercedes tech, including AMG engines and hybrid systems, which helps speed things up.
And that partnership's going to be critical. A lot of Aston's success depends on executing their new EV launches without hiccups. For investors, it's going to be important to watch whether they can hit those key EV production milestones, comply with new emissions rules, especially with the EU planning to ban new ICE car sales by 2035, and maybe even deepen those external alliances. The Mercedes tie-up is good, but if we see moves from someone like Geely, that could really change the outlook for their EV business. Aston's getting serious about sustainability. They're making investments to decarbonize operations, installing renewable energy at production sites, and pushing R&D on next-gen battery tech. That lightweight materials angle is key, especially if they want to get the most range and performance out of future EV models.
I know, and investors really can't ignore the regulatory side. Like the EU and China are both pretty aggressive about carbon targets for automakers. That means Aston needs to be nimble, not just with models, but with their manufacturing too. If policies change or get more strict, it could change timelines or the shape of the product portfolio pretty quickly. So that's something to watch for sure. One thing Aston Martin's leaning into is hyper-personalization. Bespoke design, private customer events, and even digital engagement platforms are now standard features. For the type of client that buys an Aston, experience matters just as much as the badge on the hood. Plus, They're working to connect with younger, ultra-high net worth buyers who care about both brand and experience, not just legacy.
Definitely. The company's heritage still pulls in loyalists, but to thrive, they'll need to balance tradition with innovation. Investors should keep an eye on customer feedback loops and any metrics on return buyers or order backlogs for new launches. Those are the signals that their retention strategy is working. On expansion, Aston's got their eyes on more than just China and the US. There's a lot of talk about the Middle East, Southeast Asia, and new parts of Europe as growth markets. These places have affluent buyers, but the challenge is building the right partnerships and dealership networks to actually reach them efficiently.
Yeah, and like we saw in our last episode on the EU Green Deal, regional economic and regulatory trends can be a moving target. Aston needs to make sure their global playbook is aligned with those shifts, or risk burning capital for not much return if those markets don't evolve as they expect. Tech is another big piece. They're starting to commit capital, finally, to things like autonomous features and advanced connectivity. We're seeing more partnerships with tech suppliers, which I think is a smart way to leapfrog rather than build every innovation in-house.
That's a classic move in the luxury space. Licensing or co-development deals, if done right, let Aston expand its tech stack without the massive upfront R&D bills. The trick is making sure these deals fit the premium positioning. No point in adding gimmicks that undermine what makes an Aston feel like an Aston. Let's get real. The luxury sector hasn't been immune to global supply chain problems. Aston's looking at supply diversification, beefing up partnerships, and, in some cases, expanding manufacturing capacity to get ready for the next wave of EV models. There's talk of plant upgrades and even possible new sites down the line.
And it goes beyond just building more cars. Efficient logistics and tighter inventory management are crucial, especially when you're talking about batteries and all the custom electronics modern luxury cars depend on. If they can reduce lead times and keep production flexible, it gives them breathing room when the market zigs or zags unexpectedly. Let's zoom out. Globally, luxury auto demand is shifting. There's growing interest in bespoke vehicles, EVs, and even digital ownership experiences. At the same time, macro trends like rising interest rates or economic slowdowns can hit this segment pretty hard. And you've got competitors rolling out all sorts of innovations: hypercars, luxury SUVs, and more aggressive EV plans. Ferrari's consistently raising the bar, and Aston has to keep pace or risk getting left behind.
Exactly. And it's smart for investors to track things like competitor product launches, changes in luxury consumer demographics, and broader market growth forecasts. If Aston lags those trends, growth could stall fast. And some competitors are already integrating new tech or special editions to keep customers engaged year-round. There are definitely a few clouds on the horizon: risk of delays with new models, the uphill battle with electrification, and of course, anything that dents luxury consumer confidence. Remember, this segment is super cyclical. People pull back on luxury when times get tough. But there are some important upcoming catalysts, too. The Valhalla launch in late 2025 ought to help, plus management's aiming for positive free cash flow, and any moves to deepen that Mercedes relationship or bring in a group like Geely could shift sentiment quickly.
Yeah, and the sustainability piece is always hanging over the sector. I keep thinking about when tough new rules hit out of the blue. A few years ago, I remember another automaker got totally blindsided after a major emissions policy came down in Europe. So for Aston, fast execution and keeping a pulse on regulatory changes is going to be just as important as the product lineup. So, looking ahead, what should we focus on? Product launches are front and center. Valhalla in late 2025, a refreshed DBX, and more. Each could be a meaningful revenue driver if they stick the landings. Battery technology and electric powertrain efficiency are also areas where advances could really help close the gap with Ferrari and others.
Right, and there's always the wild card: potential new partnerships, maybe someone bigger coming in to accelerate tech or boost global reach. Strategic alliances have changed the landscape for a lot of luxury brands lately, so keeping an ear to the ground for that kind of news is smart for investors and industry watchers alike. It really comes down to execution in new launches and efficiency gains from technology. If Aston can combo those, they can drive earnings growth and maybe re-rate that valuation multiple. And don't discount the impact that next-gen battery and EV architecture could have. They could step up performance and range, which would really help given how far ahead Ferrari or even Porsche are now.
And as we said, watch for who Aston partners with down the road. Whether it's Mercedes, Geely, or someone new, a shift in alliances could be a major accelerator, especially if it means faster tech adoption or improved access to critical EV components. All right, let's geek out on some numbers. For 2025, management is projecting revenue growth and a path to finally positive free cash flow in the second half of the year. Profit margins are expected to tick up as the new models hit scale, hopefully. On a quarterly basis, investors should track EBITDA margins, keep an eye on capital expenditures, and benchmark progress against the company's stated milestones. Any progress on these measures, especially if the product launches run smoothly, should start to show up in the valuation and investor sentiment.
Yeah, watch for the backlog and orders tied to new launches, too. As that builds, it almost always precedes big earnings improvements for niche luxury names, assuming they deliver on the product promises, that is. Let's get straight to valuation. Aston stock is currently trading at about 0.4 times trailing revenue, which is extremely low compared to peers. Our 12-month target price is set at £75 per share, but we're sticking with a neutral rating for now. There's a lot of optionality if the company hits its stride, and a lot of downside risk if the profit and cash flow targets get pushed again. In base, bull, and bear cases, everything comes down to execution and margin stability over the next 2 years.
Just remember, current multiples are depressed for a reason. Execution risk is still high, so investors need to watch model launches, underlying demand, and the margin comeback story pretty closely if they're considering jumping in. That wraps it up for this episode. If you want to dive deeper into the full equity research report, check it out at researchsoftgatecapital.com. And, just so we're clear, none of what we said today is investment advice. Softgate Capital Research isn't responsible for any investment decisions, and please do your own research or speak with a licensed advisor before making a move on Aston Martin or any other stock.
Couldn't have said it better myself, Emily. Thanks for listening, everyone. Always a pleasure talking markets and strategy with you. Take care out there.
Thanks, David. And thanks to everyone for tuning in. We'll be back soon with more insights from around the world. Bye for now.